Welcome back to Fast Market. I'm Tom White, joined again by Kevin Hincks, and we've got Scott Bauer back with us. He's the CEO of Prosper Trading Academy. Guys, let's talk about the markets real quick.
The 2800 party is back on.
It is back
temporarily.
S&P 500 futures just under 2,800. We got the SPX at 2795 at this point, guys. So making inroads to that resistance level once again. Dollar down pretty big. We got that vote on Brexit later today.
Yep. It's driven by the euro. I think a lot of, see, that's my thing. My theory all along has been a lot of this dollar rally has been driven by Brexit. And the crushing of the euro.
That move out of the euro into the dollar, the safety of the dollar trade. But, you know, that might be ending because we're getting back up to resistance levels.
Politicians love deadlines, and you got a deadline coming up here.
Or an extension of one.
Right, exactly.
Right. Yeah, I think the vote today is if the UK is going to do one with a deal or without a deal ahead of that March 29th basically cutoff line.
Right.
But I don't know. Theresa May said she's making inroads. We'll have to wait and see. I mean, that's something that Ben Lichtenstein loves talking about because of the euro,
it's future.
The currency trade.
It's his thing.
Mm-hmm. It is. All right, guys, let's get into a discussion. First, we talked about beta weighting earlier in the show, using the S&P 500, other indices to weight your portfolio against those. But I kind of wanted to just look at the S&P 500, or if you want to look at the S&P 500 mini futures, we can talk about that, but SPX is usually what we look at when we're making a trade in the S&P 500. Now, based on the consolidation we're seeing here at 2,800, what are you guys looking at as far as SPX goes for a trade, Scott?
So we talked about this earlier. You know, it's been up here 5 or 6 times already, and what's going to happen here? I don't know. I'm looking at the trade over the last 45 minutes or so, and there's, like you just said, a lot of volume consolidating right here. And you know it's a pivot point. You know this is a pivot point. Longer term, I'd love to buy some downside protection because of the volatility. I actually think just from reading the tea leaves here, I think this could be the time we pop through here. So I would look for a quick pop above, actually, and through.
Now, do you use something like a long vertical strategy on the call side, or do you sell more puts even though volatility is falling like we
It really depends where volatility is. Where's that IV rank, you know? And I'm sure if we look at volatility in the SPX right now, we're going to see that IV rank probably down around the 20, 25 percentile would be my guess. And in that instance, I would use a long call vertical as opposed to selling a put spread.
Yep, that's a great way to take advantage of a bullish sentiment in a low volatility environment, Kevin, when you're buying something at the money or slightly in the money and then selling something above it to make it risk define, lowering your costs. Because we talk about selling verticals all the time during high volatility environments. We've got a low volatility environment right now.
Right. It's because think about this. All you're going to make if you sell a call vertical here, let's say in the SPX, is the credit that you took in on that call vertical, and at low volatility levels, that number is going to be lower and lower and lower.
Right. So let's just bring up kind of what Scott was talking about here as far as particular positions on something like that. Now, would you look at 2 weeks out, 3 weeks out, 1 week out, Scott, on something like this?
I'd probably go out a couple weeks, and I may even look to do a calendar, an upside calendar, if volatility is so cheap. Because you know, any bump up in volatility here is going to help the position, even if there's a little sell-off in the marketplace. If we get a little bump in volatility, that's going to help. But I would probably go out 2 weeks here. You have the March 29th options up here, and that's where I'd go to.
Okay, so do you look at the money, or do you buy something slightly out of the money if you think we're going to go higher in there?
Yeah, I'm going to buy something slightly out of the money. I don't need to be so aggressive here.
Okay.
And if we go out a couple weeks here, what's the expected move? Around $65,
yeah.
So I'm not going to go all the way up to 28.65, but I may look to do like a 28.30, 28.50, or somewhere 28.
A little bit wider,
60,
right?
Little bit wider.
Well, we'll just look at the 28.30, 50 call vertical.
There you go.
$20 wide. You're only paying about $5.50 on that particular trade, so you've got nearly $15 worth of potential reward on that trade if it does go up. It doesn't even need to go up the $65 that the option market's pricing in on that particular trade. Now, Kevin, when you look at something like this where he's buying something out of the money, he really lowers his cost by buying the out of the money call vertical. Do you like that setup as opposed to selling a put vertical in a low volatility environment?
Well, in the low volatility environment, I mean, obviously the long call vertical works because you're paying less for it. Selling a put vertical in low volatility doesn't appeal to me because I think I'm working against the overall implied volatility, right? In terms of Vega. This will give you positive Vega. A calendar spread will give you positive Vega. Those are the two low volatility trades I want to do. I don't want to get into shorting verticals on either side here at low volatility. Calendar spread.
Yeah, Friday afternoon was the time to sell.
For sure. For sure.
Yeah, and you made that point, long calendar also in low volatility environments. So that's one way to take advantage. Kevin, you had another trade in there. Why don't we go ahead and put Scott's in a couple times?
All right.
And we'll go ahead and work that. Now, remember, you do have that ability where the S&P 500 goes up to 2830, and that thing doesn't expand in value if volatility crushes on that. But the nice thing is you got 2.5 weeks in that particular trade.
And listen, I can always adjust this, maybe try and butterfly it off.
Right.
So, you know, I definitely have some, no pun intended, some options.
Right, yeah, exactly. Kevin's got another strategy up here. A low volatility environment, maybe hoping for a potential move lower and a rise in volatility because this is a long Vega position with a 27. What's the strike on that? 27.25?
27.25.
Yep.
But what's that? About 3% lower.
Yep. There's the calendar. You're buying the April monthly, selling the March 22nd weeklies, which expire in 10 days.
Right.
On that particular trade. $14.75 debit is your risk on that, right, Kev?
Right, exactly. And that's all you would have at risk. And remember, the April gives you a chance to roll these and lower that break even each time.
And
if you don't get your move.
The way a calendar like that works also, unless you get an explosive move higher, this thing's really not going to go down in value too much over the next 5 to 7 days as we approach that March 22nd.
It won't be profitable, but you're not going to get creamed. It's not going to zero.
Exactly.
Right, because you're buying it in that low volatility environment. It's not going to go down much more because the VIX is already at 13. Another way to look at this, guys, versus beta weighting, if you're long portfolio in the S&P 500 and you've got a bunch of deltas, this is a way to take advantage of that, get short deltas with the expectation.
Play the other side of the market.
Exactly.
Without having to liquidate and take a tax event on your portfolio.
Exactly. You can sell call verticals up above to protect your portfolio with a move down, but buying calendars to the downside, Kevin, you do that all the time.
I do it all the time.
Yep, and that's a great way to take advantage of that.
I keep the long deltas that I want to have on, and if I think the overall market has risk, I do SPX calendars against it.
And buy some time.
Yep, and you buy some time, take some of those profits off by buying put calendars to the downside as a hedge against a long exposure portfolio to equities. But Kevin's got both of those trades working.
One's filled, one's not.
Okay, so we're going to go ahead and work those. But now let's move on to a discussion about Square because we just talked about it during our cash tag segment. Scott, this stock fell 50%. From the end of or middle of November to the end of December. Now it's up 50%, about $77 a share. We're starting to see consumer sentiment really pick up in there, and the Swans and team from Folio kind of gave us that scenario. Stock's back at 77%, so 50% off of those lows. What do you think here in Square?
You know, there's a lot of momentum behind it right now. There's technically and fundamentally, and there's the usage, the acceptance on the street of these types of payment options are just growing exponentially. Yeah. I think you gotta I like this stock a lot. This is a candidate for me that I would look at volatility, and if volatility is lower than the 50% level of the range that it's been in, I'd probably look for an upside calendar here.
Oh, looks like you're already through earnings. Yep. So the next earnings event's not coming until maybe the end of May.
End of May. Right. And to Scott's point, if you look at the current IV percentile rank in there, over a 52-week period, we're at 12%.
Crazy.
At the very low end of a 52-week range of volatility.
And what do we want our viewers to trigger? Low implied vol, low IV percentile, right? Calendar, something in the long, calendar diagonal, something in the long.
the 22nd is about what,
$4,
$5?
$4.50
Okay,
bucks.
so I'm probably looking at the 82.5 strike. Or if I go out to the 29th and that expected move is closer to 6,
Yeah.
I adjust those strikes appropriately.
Yeah, oh, that's a great way to look at it. Using the platform to gain what the option pricing giving you for that one standard deviation move over the duration of that. Kevin's created something here. He's buying,
April 5th, March 22nd, 82.5 calendar, only 76 cents.
that's only $2, 2 weeks wide, right,
Right,
Kev?
right.
And that's something taking advantage of another basically you need about $2 to $5 move higher in this for this to pay off. But you do have break even around 78 bucks, so it's not too bad.
Can you do me a quick favor
Yeah.
on that one? Can you turn that into a diagonal? So we're still long volatility, but make it the 82.5, 80 diagonal.
Yep.
Oh,
By
okay.
the 80s.
So you're buying
that?
something a little bit
want me to
closer
Give
to
me a
the money.
little more bump to the upside here.
Yeah.
And still getting long Vega. Sure,
There you go.
It's going to cost me more.
It's going to cost you more. You got to take the.
But that's the payoff. It's giving you more ferocious of an upside delta.
Yeah, it's going to cost you double what the other one was, but it gives you more upside.
And still
bonus
long
on it.
volatility.
Yep. All right, guys, that's going to wrap up today's show. Kevin's going to put that in a couple times on that diagonal. I'd like to thank Scott Bauer, he's the CEO of Prosper Trading Academy, for joining us once again, and Kevin Hincks, as always. Tune in tomorrow, 10 a.m. Central Time, right here on the TD Ameritrade Network. Have a great day, everybody.